Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Module D Credit Management Term Loans of CAIIB. Now, after reading this lecture, you will understand the meaning of term finance, what is deferred payment guarantee, how the assessment of term project or finance is done, what is techno-economic feasible study, and what is infrastructure finance. Now, banks provide term loans normally for acquiring fixed assets like land, building, plant, machinery, and infrastructure, while the working capital loans are provided for sustaining the current level of working. Now, in exceptional cases, banks also provide term loans for current assets also, which is called working capital term loan. Now, as we all know from the last chapter of working capital, that the business enterprises is supposed to bring a part of the fund required to maintain the desired level of current assets from its long term sources, which could be capital or term liabilities, which is also called net working capital, so that the stipulated current ratio can be maintained. Now, if the enterprise is not able to bring in the required amount of net working capital, it will feel liquidity crunch and the business operations will be effective. Now, in these cases, the banks may provide working capital term loan. Now, working capital loans are normally sanctioned for 1 year but are payable on demand. Term loans are payable as per the agreed repayment schedule, which is stipulated in the terms of sanction. Therefore, for the purpose of matching assets and liabilities of the bank, term loans are considered long term assets while working capital loans are considered as short term assets. Now, as a term loan is expected to be repaid out of the future cash flows of the borrower, the debt service coverage ratio assumes greater importance. While considering term loans for working capital loans, the liquidity ratio assumes greater importance. So, if you have to tell or if a question is asked, for term loan, what is important? Debt service coverage ratio. For working capital, what is important? Liquidity ratio. Now, there is no repayment schedule for all term loans. Each term loan has its own peculiar repayment schedule depending upon the cash surplus of the borrower. Now, what is deferred payment guarantee? It's a very important concept. Let me explain you in very brief way. Now, when a purchaser of fixed asset does not pay to the supplier immediately but pays according to the agreed repayment schedule, the bank guarantees this repayment. The guarantee is called deferred payment guarantee. So, this is a non fund based method for financing purchase of fixed assets. I hope this point is clear. The risk involved in deferred payment guarantee are same as those of term loan, and therefore the appraisal of deferred payment guarantee is same as that of term loan. Now, what is the difference between term loan appraisal and project appraisal? Now, for appraising a standalone term loan proposal, all the concepts involved in project appraisal may not be necessary to be applied, though all the concepts of term loan appraisal are applicable to project finance also. So, if you have to summarize the difference, in project finance, all the financial needs of the enterprise, including the working capital requirement, are appraised. After assessing the total requirement of long term funds, the bank decide upon the amount of term loan to be sanctioned and the contribution of the promoters. So, overall, you can say a project finance is a holistic approach that takes into consideration both the short term capital, working capital, and the long term loan. Second is, if an existing enterprise wants to purchase a few machineries which are not going to have a major impact on the volume or composition of the business, It will serve little purpose to have a detailed examination of techno-economic feasibility, managerial concept IRR. So this is why it is important for banks to project for the next 2 to 3 years and find out the debt service coverage ratio. Now, what is project appraisal? Now, project appraisal is a very important terminology and a term for appraising the project. Now, it involves appraisal of managerial aspects, technical aspects, and economic aspects. So, if you hear this word project appraisal, these three things comes into picture: managerial aspects, technical aspects, and economic aspects. Now, if you talk about managerial aspects, in the appraisal of managerial aspects, the credentials of the promoter is checked. Uh, what is the financial stake of promoters in the project? Can they bring additional funds in case of contingency arising out of delay in project implementation? What is the form of business organization? Who are the key persons appointed to run the business? When we talk about technical appraisal, now, technical feasibility of a project involves the following aspects, such as location, products to be manufactured, availability of infrastructure, provider of technology, details of proposed construction, contractor for proposed execution, waste disposal, availability of raw material, marketing arrangements, etc. What is economic appraisal? Now, in economic appraisal, there are certain things which is taken into consideration, such as the return on investment, break even analysis, and sensitivity analysis. Now, appraisal and financing of infrastructure sector. Now, this is something which is a huge sector, and in this, transport, energy, water and sanitation, communication, social and commercial infrastructure comes into picture. If we talk about types of financing by banks, now there are different types of financing which the bank does, which is called takeout financing, inter-institutional guarantees, and financing promoters' equity. Now, appraisal, if we talk about appraisal of these projects in respect of financing of infrastructure projects undertaken by government owned entities, the banks and financial institutions should take due diligence on the viability of the project. Infrastructure projects are often financed through special purpose vehicle. Financing of these projects would therefore call for special appraisal skills on the part of lending agencies. What are the prudential requirements? Prudential credit exposure limit. Credit exposure to borrowers belonging to a group may exceed to the exposure norm of 15% of the bank's capital fund and an additional 10% up to 50% if the credit exposure in the account of extension of infrastructure projects. Now, credit exposure to single borrower may go up to 15% of the bank's capital fund and additional 5% in case of infrastructure projects. Now, assignment of risk, weight of capital adequacy purposes, asset liability management, and administrative arrangements also comes into picture when we talk about financing term loans. Now, let me talk about takeout financing or liquidity support. Now, takeout financing structure is essentially a mechanism designed to enable banks to avoid asset liability maturity mismatches that may arise out of extending long tenure loans to infrastructure projects. Under the arrangement, banks financing the infrastructure projects will have an arrangement with IDFC or any other financial institution for transferring the latter, the outstanding in the books on a predetermined basis. So, IDFC and SBI have formulated different types of takeout financing structures to suit the requirements of various banks addressing issues such as liquidity, asset liability mismatches, limited availability of project appraisal skills, etc. Now, if we talk about partial credit enhancement to corporate bonds, what does it mean? Now, the credit needs of infrastructure sector in India are huge, as the Indian corporate bond market is at the nascent stage of development. There is excessive pressure on the banking system to fund the credit needs of project development, including the infrastructure sector. Now, I hope this video would have given you a lot of insight and valuable knowledge about term loans. So let me ask you certain questions which I'm sure you'll be able to answer them in the description box below. Question number 1. A deferred payment guarantee is issued by the bank for dash by its client. Question number 2. Which of the following statement is not true for an infrastructure project? Question number 3. Which of the following is not a source of funds for meeting the cost of purchase of fixed assets by an enterprise? Question number 4. Which of the following is a ratio indicative of the repayment capacity of a borrower? Question number 5. Which of the following is not correct regarding term loans by the banks? Question number 6. Project loans can be given by the banks to dash. Question number 7. Which of the following is not correct regarding financing of infrastructure projects by banks? Question number 8. Which of the following statement is not correct for project appraisal? So if you like this video, you can press the like button, you can subscribe to my channel, and you can also share this on social media. Help us to spread education in this beautiful world. Thank you.